If you're an Aussie working hard, paying tax, watching rent climb, and wondering if you'll ever crack into the housing market, the 2026 federal budget just changed the game. Treasurer Jim Chalmers handed down Labor's first full budget since the landslide election win last year. And this isn't a fiddle around the edges. It's the biggest shake-up of the Australian tax system in a generation. And depending on where you sit, it's either the best news you've had all year or a kick in the wallet you didn't see coming. Let me walk you through what actually happened on Tuesday night and the moves you need to make before the 30th of June. First, the headline. Every Australian taxpayer is getting another tax cut. From the 1st of July 2026, the tax rate on income between $18,201 and $45,000 drops from 16% to 15%. Then from the 1st of July 2027, it drops again to 14%. That's worth up to $268 in your first year and up to $536 every year after that. Combine that with the cuts already legislated, and someone on the average wage of $81,245 is keeping $1,978 more of their own money in 2026 to 27, rising to $2,496 from 2027 to 28. Think about what an extra $2,000 a year actually does. Drop it into your mortgage and you knock years off your loan. Drop it into an index fund every month, and over 20 years, that money turns into a six-figure asset. There's more. From 2027 to 28, Chalmers introduced a brand new Working Australians tax offset. It's permanent, worth up to $250, and it lands in the pockets of more than 13 million Australians. 97% of those workers will get the full amount. You don't have to apply. You don't have to fill in a form. If you work, it's yours. And it lifts the effective tax-free threshold for working Australians by nearly $1,800 to $19,985, or up to $24,985 if you're eligible for the low-income tax offset. And here's the one almost nobody saw coming. From 2026 to 27, you can claim an instant $1,000 tax deduction on work-related expenses without keeping a single receipt. 6.2 million workers will benefit, with an average tax saving of $205 a year. There's also relief at the bowser. With the war in Iran disrupting global fuel supplies, the government has more than halved the fuel excise from 52.6 cents to 20.6 cents per litre for 3 months from the 1st of April 2026. If you fill up a 40-litre tank once a week, that's around $170 back in your pocket. It's temporary, but it's real cash while it lasts. Now, here's where the budget gets interesting, because Chalmers didn't just hand out tax cuts. He paid for them by going after the wealthiest investors in the country. Negative gearing is being reformed. Properties already owned before budget night are completely grandfathered. Nothing changes for existing landlords. But if you buy an established property after budget night, you can still deduct losses against rental income from other properties and carry forward unused losses. But you can no longer deduct those losses against your wages. The full restriction limiting negative gearing only to new builds kicks in from the 1st of July 2027. The message is clear. The government wants investor money flowing into new housing supply, not bidding up the price of existing homes. The capital gains tax discount is also being overhauled. From the 1st of July 2027, the flat 50% CGT discount is being replaced with an inflation-based discount and a minimum 30% tax on gains. In plain English, you'll only pay tax on your real capital gain after inflation is stripped out, but you'll pay a fairer rate on what's left. Investors in new builds get to choose either the old 50% discount or the new arrangements, which is another nudge toward building rather than buying existing stock. This is the change Labor promised never to make, and they've made it anyway. They're banking on the fact that most Australians don't own investment properties, and most Australians want a fair go at the housing market. The Treasury estimates around 75,000 additional homeowners over the next decade who couldn't have broken in before will now have a real shot. Less tax shelter for property investors, more opportunity for first home buyers. Whether you cheer that or curse it depends entirely on which side of the property fence you're standing on. For renters, the news is more mixed. The reforms are expected to push rents up by around $2 a week, which isn't huge, But it isn't nothing either when you're already stretched. And the government's Help to Buy shared equity scheme is lending less than expected. So if you've been waiting for that program to launch you into ownership, the queue is shorter than the headlines suggest. The ban on foreign buyers purchasing established homes has also been extended until mid-2029. Let me talk about super. The new Division 296 tax will officially kick in from the 1st of July 2026. If your total superannuation balance is above $3 million, you'll pay an extra 15% tax on the earnings above that threshold. For most Australians, this changes nothing. But if you're a high-income earner, a business owner, or someone with a self-managed super fund, you need to be talking to your accountant this month. Here's the part the headlines are missing. The $3 million threshold is not indexed to inflation. A 35-year-old contributing steadily over 30 years has a very real chance of hitting that cap by retirement. So even if this tax doesn't touch you in 2026, the long arm of it might reach your future self. That's why understanding how your super is structured today matters more than chasing the next hot stock tip. On health, there's genuine relief. PBS medicines are now capped at $25 for Medicare cardholders, down from $31.60. That's a 21% drop in essential medication costs. The 137 Medicare urgent care clinics are being made permanent with $1.8 billion in funding, and public hospitals are getting a record $220.3 billion over 5 years. Now for the losers. Rich families using discretionary trusts will face a minimum 30% tax on trust distributions from the 1st of July 2028. International travellers will pay a higher passenger movement charge, lifting from $70 to $80 from the 1st of January 2027. And anyone on JobSeeker is stuck where they were. With no real boost to the $58 a day rate, unemployment is forecast to climb to 4.5%, the highest since the pandemic. So what should you actually do? 3 things. 1, run the numbers on your tax position now. With the new offset, the lower rate, and the $1,000 instant deduction, your take-home pay is about to change. Update your budget. Don't let lifestyle creep eat the difference. Move it into savings, your mortgage, or an investment account before it disappears. 2, if you've been sitting on the fence about a first home, the playing field just tilted in your favour. The investor demand that has been crushing first home buyers for 20 years is about to ease. Get pre-approved. Talk to a broker. Be ready to move when stock comes on the market over the next 18 months. 3, if you own investment property or have over $3 million in super, get professional advice this quarter. The rules have changed. The strategies that worked for the last decade won't work for the next one. The Australians who restructure now will keep more of their wealth. This budget is a transfer of wealth, plain and simple, from older asset-rich Australians to younger working Australians, from property investors to first home buyers, from the top 10% to the middle 80%. The rules have changed, and your job now is to play the new game better than the old one. Here's the truth nobody in Canberra will tell you. Budgets come and go. The Australians who build real wealth aren't the ones who panic every May when the budget drops. They're the ones who keep showing up. They spend less than they earn. They invest the difference. They learn the rules, adapt fast, and keep their eyes on the long game. This budget gives you a head start. What you do with it is up to you. If this breakdown helped you make sense of what just happened, hit subscribe, smash that like button and turn on notifications. Thanks for watching, and I'll see you in the next one.